Every time an economy collapses, debt is supposed to shrink. Businesses fail, spending freezes, risk disappears. But look closer and you'll notice something disturbing. Global debt doesn't fall during crises, it explodes. Wars, recessions, pandemics, banking crashes, H1 leaves nations poorer, citizens weaker, the debt system larger than ever. Trillions appear overnight. Central banks expand. Governments borrow at record speed. And somehow the institutions that caused the collapse emerge more powerful than before. This raises an uncomfortable mystery. If debt is the problem, why does the system reward collapse? Tonight, we re-unpacking the hidden mechanics of the global debt machine system, not built to survive economic breakdowns, but to grow from them. And once you see how it works, you may never look at a crisis the same way again. To understand the debt machine, we need to rewind not decades, but centuries. For most of human history, money had limits. Gold, silver, physical scarcity. Governments could spend only what they could tax or mine. Debt existed, but it was constrained by reality. That changed slowly. Then, suddenly. The first major shift came with central banking institutions created to stabilize economies during panic. The Bank of England. Later, the Federal Reserve. Their mission sounded noble: prevent collapses, smooth cycles, act as lenders of last resort. But embedded in that mission was a quiet transformation. Money was no longer just a medium of exchange. It became a policy tool, and debt became its delivery mechanism. Instead of governments earning or saving money, they borrowed it often from banks that created it digitally, backed not by gold but by future tax promises. This is where the first twist appears. Debt wasn't a temporary bridge. It became the engine. The modern debt machine truly took shape in the 20th century. After World War I, governments were buried in obligations, reparations, war bonds, construction loans. Rather than dismantle the system, leaders doubled down. Then came the Great Depression. Banks failed, markets collapsed, unemployment soared. The response wasn't to reduce debt, but to centralize control over it. Governments borrowed massively to stimulate demand. Central banks lowered rates. Deficits became patriotic. This established a precedent. When the economy breaks, borrow more. After World War II, this logic hardened into doctrine. Institutions like the IMF and World Bank were created to manage global debt flows. Nations were encouraged to rebuild using loans, not grants, locking recovery to repayment. Growth became debt-fueled. Stability depended on constant expansion. Here's the key design flaw. If growth ever stops, the system destabilizes, so collapse becomes useful. Fast forward to the late 20th century, currencies detach from gold. Money becomes entirely fiat created through lending. Banks no longer wait for deposits. They generate money by issuing debt. This creates a powerful feedback loop. More lending creates more money fuels asset inflation. Asset bubbles eventually burst crises, justify emergency intervention. Intervention requires even more debt. Each cycle increases total leverage. By the time the 2008 financial crisis hit, the machine was fully operational. Banks over-leveraged. Mortgages securitized. Risk hidden. When it collapsed, the public expected consequences. Instead, something unprecedented happened. Governments didn't let debt fail. They absorbed it. Private losses became public obligations. Central banks printed trillions. Interest rates dropped to near zero. The system didn't reset, expanded, and the message was clear. Collapse doesn't end the debt machine, it feeds it. By the 2010s, global debt surpassed global GDP by a wide margin. Governments owed more than they could ever realistically repay. Corporations survived on refinancing. Households depended on credit for basic living. Yet the system continued because repayment was never the goal. Servicing was. As long as interest could be paid, the illusion held. Then came the pandemic. Economic activity froze. Supply chains broke. Millions stopped working. This should have triggered a massive deflationary reset. Instead, debt issuance went vertical. Governments borrowed more in months than entire decades before. Central banks expanded balance sheets at historic speed. Emergency spending became permanent. Once again, collapse justified expansion. But something changed this time. Inflation returned, and with it, the cost of maintaining the debt illusion skyrocketed. Rising inflation exposed the machine's final mechanism, transfer. When debt grows faster than productivity, someone absorbs the loss. Not banks, not governments, not central institutions, the public does. Inflation erodes savings. Asset inflation locks out new buyers. Taxes rise quietly through currency debasement. Wages lag behind prices. Debt never disappears, it migrates. From balance sheets to living standards, from governments to households, from numbers to daily life. And here's the most unsettling part. This outcome isn't accidental. It's structural. Over time, leaders have tried everything. Austerity, stimulus, rate hikes, rate cuts, bailouts, reforms. None solve the core issue. Because every fix assumes the system must be preserved. But the system requires continuous debt expansion to survive. Reducing debt risks collapse. Allowing collapse threatens control. So the cycle continues. Debt grows. Crises recur. Interventions escalate. The machine doesn't malfunction during collapse. It performs. Today, global debt sits at historic highs. Sovereign bonds depend on central bank support. Financial markets react not to productivity, but to policy hints. Every shock triggers the same response. More liquidity, more leverage, more promises against the future. And each time, the system becomes more fragile and more entrenched. The debt machine isn't failing. It's consolidating. Debt isn't a temporary tool, it's the foundation of modern money. Second, economic collapses don't threaten the system, they justify its expansion. Third, the cost of sustaining the machine is transferred silently to society. The question isn't whether the cycle will repeat, it's how much pressure the system can absorb before confidence breaks. Because debt only works while belief holds, and belief is finite.